Hi, everyone. Monday, February 14th, Valentine's Day. Happy Valentine's Day to all. It's the Monday main event for Barry McGuire's Creative Real Estate Education Group. And, every Monday we show up and we talk about all things real estate related. We have experts on in tax and insurance and finance to help us work through their particular areas of expertise. We're looking to help you turn your creative business into a really win-win profitable business. That's what we're trying to do. Part of what we do is Don and I teach courses, as you know, and we're so happy and so stoked that our very first Rapid Cash program in 3 years, the last time we did it was May of 2019 in Edmonton. The next one's coming up May 7th and 8th in Calgary, a 2-day event. It's going to be absolutely fabulous. It's the kind of education that you need to carry on and really build a creative real estate business. So you can check on the website barrymcguire.ca for that and get more detail. Now for today, we're going to talk about multifamily real estate, one of the aspects of multifamily real estate. And to help us out, we have the redoubtable Garth Chapman is going to help us. Garth is a longtime REIN member, longtime investor. He's done a ton of creative things on his own. He is a mortgage broker with Gencor Mortgage Corporation out of Calgary. He understands how numbers fit together. He's created his own software to help people track properties and do a zillion financial calculations automatically that none of us want to do on their own. He knows residential and multifamily real estate up, down, and sideways. And so Garth is here today to help us talk about a new CMHC program called MLI Select. MLI Select. So let's bring Garth on. And Garth, do you want to? Hey, there he is. Garth is enjoying the sun in the United States of America right now, where it's 27 above and not a breath of wind, and it's beautiful, and he's enjoying the heck out of it, and he's going to stay there till there's no snow on the ground before he comes back to Calgary. So that could be late April or May, for all we know, Garth.
Indeed.
So, Garth, I gave you a little bit of an intro, a little bit of a bio. I know there's way more to it than what I said. Is there anything else you'd like people to know about you as an investor, as a mortgage pro, as a guy who knows his way around multis? Tell us a bit more of what's relevant about Garth Chapman.
Well, first, Barry, I just want to thank you and Donna for inviting me to do this. Timing is great. Things are changing in Canada in so many areas. Some ways, problematic right now, but we'll come out of all that as we always do. And at the end of the day, we have a housing problem in the country regarding cost, and in some areas of the country regarding affordability, as that relates to that, of course, but also regarding quantity, number of residential units available for people to rent or to buy. And if we're truly going to turn on the taps and have 400,000 immigrants a year coming into the country, I mean, that's probably 100,000 homes. We need to buck up our building along with housing formation, some of which is reversed from, people who went home to live with mom and dad, or parents who went home to live with the kids during COVID when it hit 2 years ago. So there's going to be a lot of pressure. Our housing starts are now at an all-time high. Last I looked, 232,000 were underway. But we need to be above that number for a sustained period, because we haven't really built for well more than a decade enough to keep us going. These problems are primarily in Greater Toronto area, Greater Montreal, a little bit in Ottawa, which is about the size of Calgary, and quite significant in the Lower Mainland, Vancouver and environs. So again, thank you for that, because the timing is right. So just for a little bit of background, I got involved in real estate in 2002. I spent a year learning from my son. who was heavily involved in teaching real estate and in flipping properties and buying rentals and holding. And I bought between 02 and 07, 6 years, I bought 90 properties in Alberta, flipped 60 and kept 30. And things went from there. We bought also apartment buildings and did condo conversions. We did a little bit of, small development work and that sort of thing, and got a good background. Wrote that software, which is really a legacy piece now, and got bored and needed something to do. So I decided to become a mortgage broker in the January of 2009. So I guess this is my 13th year. And I'm having a blast. Much like you, I think, Barry, I don't need to work. I love what I do. I'm well past the age where normally one would aspire to retiring, and I don't. So it's great, as always, to be chatting with you. We're of such similar minds and situations, and we have the privilege, and it is a privilege to be able to do the things that we truly enjoy doing and trying to make a difference and help others with what they're trying to achieve in their lives.
Yeah.
So I enjoy that.
Isn't that it? And as I hear you talk about what you did, 90 properties between 02 and I think you said 09, flipped 60 and kept 30. Folks, did you hear that? That's a lot of properties to do in a short period of time, but Garth got the result out of that between those 30 properties and some of his other endeavors, he's his own man. He doesn't have to work. He's working because he loves it. So when you folks who are interested in creative real estate think what it can do for you, well, that's what it did for Garth. So
well said.
You see that. So Garth, we're today going to talk about the new CMHC, the new Canada Mortgage and Housing Corporation, MLI Select program, which is all about multifamily buildings. And you and I had some brief conversation around the leap that it is to move from buying a townhouse here and a fourplex there to doing multifamily work. The leap that there is from buying that same townhouse or duplex and deciding you're going to be a developer. I think you and I have both observed over the years that those are, it is a big leap to make. It is quantum leaps to make, to go from being, a small single family guy to being a multifamily guy or girl, or a developer. And so we said to ourselves, as we're talking about this new CMHC program about multis, maybe we should have had some initial conversation about multis on their own and not about the new program, because as you know, that's a common theme when investors talk to each other. I'm doing this and I'm doing that, but they say, I want to get into multifamily. And so there's lots to be said without talking about MLI Select on wanting to get into multifamily. And so as we go along today, I'm expecting that some of the things we're going to talk about would have had, a more general conversation as a better background, but we can do that another time. I think there's enough material that we can come back and dig into it. I mean, maybe we'll do it next week if you're available, depending. So with that said, let's build on what you said about the government wants, and I've read it myself. They want to get to 400,000 new folks coming to Canada, 400,000 immigrants coming to Canada. There's talk everywhere about the lack of housing, how housing, if you can find it, is unaffordable, how a shack in Vancouver or Toronto is $1 million+ and I mean a shack. And so there's huge pressure on our housing system. How does anybody buy those houses? I'm a lawyer, and when I see those prices, and I do pretty well, when I see those prices in Toronto and Vancouver, the Lower Mainland, and the Golden Horseshoe, I'm going, who is buying all those houses and how can they afford them? But it's a cinch that Joe Average can't afford to buy housing there. So, I mean, that's the background that I think is that we're facing, that's causing somebody like CMHC to say, okay, we might need a new program. And maybe you can start out by telling people just a bit more about CMHC, who they are, why they exist, and what they're trying to do before we move into their new program.
That's a great idea, Barry. That's a great idea. Let's do that. And as to coming back and speaking to the whole issue of how one makes the transition from small rentals, singles, duplexes, fourplexes, up into the multifamily world, which is a big shift. I'd be happy to do that. I think it would be helpful. I can't tell you how many calls I get from people who will say things like, I've got $250,000 and I want to buy an apartment building, and are shocked to learn what all goes with that. And most of them just go away going, wow, I didn't think this was anything like that at all. I'm going to go buy a couple more fourplexes. So I think it'd be nice if we had an opportunity to teach people in the overview what that landscape looks like, so that they're better prepared when they start thinking about wanting to go in that direction. Some of them, unfortunately, go quite a long ways away on down that path, saving money, making plans, not doing other things because this is where they're going to go. But before they come to somebody like me and Gencor and find out there's much more to it than they thought. So yes. I'd be happy to do that.
Okay.
So CMHC started, if I remember, in 1946, right after the aftermath of World War II, and its objective was to create for veterans coming back from war the ability to buy homes with low down payment. Because back in those days, mortgages were pretty rare, and a minimum down payment was at least 25%, if not more. And we've all got ancestors who could tell us those tales while they were still around. I certainly did, and it grew from that over the years. In the boom years in the 1950s, when the baby boomers were all born. You and I and others, and they gradually it grew significantly. It's a Crown corporation still to this day. It takes its overview direction in terms of direction from the federal government. It answers to the finance minister, and we can see in this new program how that works. It at one point got to a point where it was 5% down was sufficient, but it was only for first-time home buyers. And believe it or not, that's been gone for probably 30 years, that rule, certainly 25, if not 30 years, where it's been opened up to anybody buying their home or a second home at as little as 5% down. I still get the odd call once or twice a year from somebody who says, well, I'd like to do less than 20% down, but I'm not a first-time home buyer. They still think that rule's out there.
Yeah.
So anyways, let's talk about the motivation for this. And you and I have set that up just to some degree, I think. So CMHC has a current program they've had for many years called MLI Flex. The new one is MLI Select. It launches March the 7th. And the motivation behind it, and they did a pretty good job in their launch. And I will give you, Barry, which you can share with everyone, the link to the recording of the roughly hour and a bit webinar launch that CMHC did. And the lead on the whole program, who's a very, very good communicator, did an outstanding job in explaining it. So that will be helpful for people.
Super, Garth. Thanks.
So I'll get you that. So they come out with 3 desired social outcomes. Number 1, housing affordability. Number 2 is environmental impacts, so reduction of GHG gases and that sort of thing. And the third, and a distant third, they're very clear on that, is accessibility issues. So wheelchair access into apartment buildings for people, not only into the building, but into the elevator and into the doors of the units, which have to be wider to accommodate the wheelchairs, and heights of countertops and access into the toilets and tubs and sinks and all that sort of thing. So those are the three desired social outcomes, is improvements for people in those three areas. And as I said, the most important is housing affordability. The federal government has driven this, obviously. There is a desire to act on housing shortages existing primarily, as I said, in those areas, in the bigger centers in Canada, and to have enough housing available to permit the restart of the planned immigration. Some might argue, and I literally, in this process of learning about this program and what it's going to be and what it's intended to be, I've had more than one person tell me that they believe that this is a lot about, some would argue that this is a lot about the government providing the perception of action as paramount. And secondarily, if they get some action and help solve the problem, that's great. But so that speaks to us about the level of, what would the word be? Skepticism that's out there now. Full disclosure, I'm not a fan of this federal government. I'm hardly a fan of any government in Canada right now. I yearn for the days in the 80s when we had real leaders who did bold things, whether you liked them or agreed with them or not. Bold things. So those are the motivations that put it together. So how will it be different from the existing program, which allowed up to 85% loan-to-value financing? This one goes to 95. MLI Flex allowed up to 40-year amortization. This one will allow up to 50-year. The previous program allowed debt coverage ratios must be at minimum 1.3 on the subject property being financed. 1.3 means that your revenue must be 1.3 times your expenses after all costs are included, including allowances for vacancy, etc. The new program is only 1.1. So those three key things, 95% loan to value, 50-year amortizations, and 1.1 DCR means it should open up, you would think, a whole lot of opportunity for investors, large and small, and the big developers to build lots of new product because those guidelines make it easier for them to be financially viable. Now, with a 50-year amortization, you're buying for your grandkids or your kids, depending on your age. In the big corporate world, they're not. They're buying for shareholders, and they're buying for ROI and cash flow and share values. So, is there a place here for small investors as well as for the large ones? I think in the right areas and the right timelines, yeah, there is.
So, Garth, then are we talking strictly brand new construction, or is there room to, I'm just thinking of, the accessibility side of it. If you own a building that maybe fits all other criteria, it'd be tough doing a renovation on an existing building if you have to do more than front door access and elevator access.
So great question again, Barry. There's a points system now, and you can get points by allocating a certain percentage of your units to being affordable rents. And the definition of that on the surface looks really good. And I'll get into later where I've learned only this week, that's today, that there's some underlying criteria that they didn't talk about in the launch that changes how that really is going to work. So you can choose a percentage of your units from 30% on up. And at 30%, you'll earn, I think it's 50 points. You only need 100 to get to 95% loan to value and 50-year amortization. If you got 50 points, you can get to lesser levels. It might be enough. But you could also choose not to be on the affordable side and get your points on the environmental side. So you could get points on the accessibility side. You could marry those two together and do no affordability. But you do run the risk that a CMHC says that's not good enough, because affordability is the most important thing. So we need some of that on this deal, or we're not going to approve it. And I could see that happening. So the points, and I'll share with you to share with the group how this all works and how the points look and how you can mish and mash things together to get yourself to the level of points you want to achieve the level of financial viability that you want for a building. But to go back to your question, I do think this is going to be a lot easier for new build properties where you can build into them the accessibility and the environmental impacts without having to give up some rents, because where the rents become affordable, you're signing a 10-year commitment that they must remain affordable.
Oh,
So
10 years. Okay. All right.
and you can do 20 years and get 30 extra points. And again, that's corporately, that kind of works. You know, you're building 2, 3, 4, 500 unit complexes of multiple buildings. You can set aside, you can make them smaller, you can make them more cheaply. You can earn points much more easily on the environmental side and the accessibility side, and set aside a modicum of units on the affordability side, and it's still pretty good financially, especially again with those other three criteria: the 1.1 DCR, the 50-year amortization, and the 95% loan to value. You're not putting up very much cash to build a building, and they'll literally finance the construction at 95% of cost. So you're putting up a $500 million major complex in a major city, and all you got to do is put up $25 million is 5%, right?
Yeah, for large companies who are in this business, that would be, their mouths must be watering at the possibilities here. I mean, so far, Garth, all of this sounds just ducky. This sounds great. All of those benefits you get from in the new MLI Select program. Yeah, you got to build new. Is there a
Well, let me stop you there. I didn't say the other side of this. You don't have to build new. Okay. I just think it'll be easier. Yes. From everything I can see here and from speaking with lenders and CMHC directly. You can refinance an existing building, and we think there's an opportunity here. You can purchase an existing building or an existing, I'll call it an asset. So it's a building or 2 or 3 buildings together in a complex, or you can come down as small as 3 duplexes in a row that are contiguous to one another with no buildings in between them. Mm-hmm. CMHC will allow that to be treated as multifamily. It's 5 units or more, and we did a couple of those last year, and that was a nice fit. Now they were on new build properties in Calgary and Edmonton, but the prices have gone from, let me see, $220 a unit to $325 in 16 months. So they're now being bought by Ontario investors and Lower Mainland Vancouver area investors who can't get that kind of product for anywhere near that price where they are. So they're buying in Calgary and Edmonton primarily, and they have overbid the markets to the point where locals can't buy those because they don't cash flow, they don't make sense. But when you're from those overpriced areas, you're not focused on cash flow. You become focused on value appreciation. And I think, frankly, that to some degree, you become as much a speculator as an investor. Mm-hmm. And I think it's one thing to speculate on value increases in the GTA, in the Golden Horse Show, as you called it more correctly, and in Vancouver and those environs, than it is just about anywhere else in the country. Yeah, I agree with that. So you can do, and we think the opportunity here for existing owners of multifamily buildings is who've owned those buildings for a while and they are paid down, is to do a refinance into this program and land themselves a big wad of cash and then go build a new building. Oh. Now, there's another little criteria here. So if we go back to May of 2020, when COVID was rip and roaring, really got going, just about everybody in Canada who owned an apartment building or two decided that this would be a great time to refinance it because interest rates were down as low as 5 and 10-year fixed terms at 1.5, 1.6, 1.7%. You have to take that money. Yes. So everybody was trying to refinance their buildings. And within a month, CMHC by the end of May made an announcement that going forward, and the rule is still in place, all refinance funds that kick up new money after you've paid off the old mortgage and your expenses for getting the mortgage put together, the fees, etc. All new money must be reinvested in newly purchased to you. Doesn't have to be new building, but new residential rental properties, typically of 2 units or up. So you could buy a duplex, you could buy another apartment building, you could have one built, but you had to put all of that money back into growing your portfolio of rental properties. Yeah. And typically you had a couple of years to do that. Every lender can treat that a little bit differently. And there's lots of talk about, well, how are they going to punish me if I don't do it? What if I just take the money and buy a yacht? And nobody really has an answer yet, but I think the simple answer is, when it's time for you to renew that mortgage that you just refinanced for another 5 or 10 year term, when it comes up due to be renewed and you haven't done that, you're not getting a mortgage.
Yeah. Yes. So, I mean, that, I guess there was a few people who managed to refinance before CMHC said, hold on. We're in business to help folks and make sure there's affordable housing and generally to move that whole thing along. We're not in the business of helping people scoop buckets of cash out of their buildings and disappear with it. So yeah, I can see why that would have shown up, and it's still the rule today. So if you're going to refinance, you got to put it back in. But I mean, that fits with what you were saying, which is if you have an existing building and you want to build new, well, here you go. You can refinance your existing, get out the chunk of cash that CMHC would require under the new program, which, as you say, could be 5%, and there's what you need to move along under the new program. So that's a good idea. I like that idea.
It's a smart program in many ways, but it is a multi-layered thing. It's like, what do they call that breakfast? The wife saver, layer after layer of food, bacon and eggs and etc. It's like that. And it's like peeling an onion, maybe a better phrase to use. You just got to keep peeling until you get to the core of it, until you really understand it all. And we're still peeling. Lenders are still peeling. And CMHC is being brought. Being brought to them are things like, well, how are we going to handle this, and how are we going to handle that? We got a problem here. So what I learned today. So on the affordability side, Barry, it's brilliant. They're saying that the affordable rent is defined as rent that does not exceed 30% of the median income in the community. So in Edmonton, the median income times 30% yields you a rent of $1665 a month. Well, that's pretty good, right? In Calgary, it's $1797. Let me give you some numbers here. Where did I put them? Here we go. Vancouver, $1678. Well, that's not as good. Rents are a lot higher there.
Yeah.
Incomes are not as high as they are in Alberta. So Alberta's got a benefit here, but we're not going to get to use it very quickly, I think. And I'll explain that. Okay. The benefit is we have the highest income in the country outside of the Northwest Territories and Nunavut, and maybe the Yukon. We have lower rents than just about anywhere else in the country, other than the Maritimes and little bits and pockets here and there. So this should be perfect for us. So we started digging around and asking questions. Well, is that 1797 in Calgary and 1665 in Edmonton? Does that mean we could just build a building full of bachelor apartments and charge 1665 in Edmonton for them? And we learned that CMHC does not intend to stipulate which units must be the ones that are deemed affordable and hit the number for your city. I'll give you a couple other numbers. Lethbridge, 1075. Red Deer, 898. You can tell I'm a little Alberta-centric. Toronto, 1348. That sounds terrible.
Yeah.
Right?
Wow.
So then you dig a little deeper and you find out that when you peel the onion, you learn that you take the Edmonton number at 1665, Now CMHC is going to force the lender to dig out the data, which they have access to. It's all CMHC's data, and prove that 1665 in this building, in this community in Edmonton, is not above market rents. So I talked about a building in Sunelta today with 22 or 3 units where the rents are $1,000 and the market rents are $1,250. So the buyer is going to be very happy. The early word is that's acceptable. Now, if that building, if those units really are worth $1,250, maybe they need to be renovated a little bit. If I was that buyer, I wouldn't do a straight off purchase into an MLI Select and pick up my 10% down or 5 or whatever it works out to, and have those units and not even have to bother with the other 2 criteria. Just do it all on affordability because it's already there, slam dunk, done. I wouldn't do that. I would buy the building with probably a 1-year term conventional mortgage, a little bit higher interest rate, but not much anymore. They're almost the same. A higher down payment, that's fine. And I would stabilize the building. I'd do the improvements that are required. I'd get the rents up to the market rents of $1,250, and show the financial statements that show that that's what we've now got, and refinance it in a year out into the MLI Select, and now take advantage and get all my money back, and then go do another deal, because getting that money out means I'm now that ETO money has to be reinvested. So it's not 1737 in Calgary or 1665 in Edmonton. It's subject to the limitation that it within that area, and they dial it right down very close within communities, that it's not above market. So it must be affordable in the true sense. So it'll be lots of work and lots of time to figure out, the due diligence on doing, thinking about writing an offer on a building just got more complicated. It's going to take a little bit more time.
Yes. Yeah. As you say, you can't put together a program like this. I mean, CMHC is full of smart people who's they work there. I mean, it's their career at CMHC, and they work hard on their programs and they put it out. But as soon as that happens, it goes out to equally smart people who start doing as you say, okay, well, what about this situation, and how do we handle? And so it's going to be a while before those nuances are understood and it's all worked out, and it'll change as they go along. CMHC isn't shy about changing the rules, I don't think, if they feel that the rules need changing. So it's going to take a bit of time. And it launches on March the 7th, I think you said.
It does. Yeah.
March the 7th. So we're just under a month away from that.
And there are questions that have come up now, and they spent months on this, Barry, in consultation with large lenders and with large developers and with builders, consulting on how to achieve their 3 stated objectives, the social outcomes that they wanted to see. So this wasn't, done in a back room somewhere. They involved lots of people over an extended period with 3 different rounds of, as I remember it, of consultations. Yeah. But even so, there were a whole whack of questions that came out in the first few days of this being announced from other people on, well, what about this, and how are we going to do that? So a couple of those, for example, the affordability requirement that you commit to. Let me back up. When you make an application for a CMHC insured mortgage, you can do it with a lender direct. You can do it through a broker who will go to a lender and put the thing together, or you can do it with a broker who has who is authorized by CMHC to make direct submissions without needing the lender, and that's the sweet spot. And we now have that. So we now have hooked up with a sister brokerage, a Dominion lending brokerage, also like Gencor, with lots of experience in this, and they have this direct submission capability.
Well, excellent.
So that means, and the reason that's good is when the lender gets the commitment from CMHC, which is referred to as a certificate of insurance, a COI is the vernacular. That's the same as a mortgage commitment from Scotiabank for your duplex. And it's good for typically 6 months. It can be extended if needed, and you have a good reason, and we've done that. But when that COI has been achieved by a lender, they kind of control it. And if you want to have the other lenders bid on that mortgage when it's ready to fund, the lender who got it for you is going to want to be paid for their efforts. And that's fair.
Yeah.
And it ain't cheap, generally speaking. Sometimes it is. So we like the idea, and that's why we've gone to this effort of being able to do a direct submission. Then the COI is owned by our client, and we, on their behalf, will shop it to all the lenders.
Right.
And better rates and terms will be the result.
Well, that's magnitudes better doing it like that.
It is.
Than either using a broker or going directly to a lender, for sure.
Mm-hmm.
Yeah, no, I like that. That's good. And so Gencor has that connection, and you guys through your sister brokerage can do that direct submission. So that's a really good thing to know. It's a really good thing to know. Now, Garth, as you've been peeling the onion, tell us a few more things that have come up either because you've learned them or they've come up because of questions. What else do we know now that we didn't know last week, say? Yeah,
let's look at the three key social outcomes that are desired. So affordability, there's as I said, you're making a 10-year commitment to the affordability, and the way that works is your rent that is allowable to meet that affordability criteria. When that rent's established, you sign up and you make a written commitment for these specific units. So let's say you decide you're going to do 30% of your units. You've got 30 units, so it's 10 round numbers. Let's just easier. So you've got 10 units you're committing for a 10-year period to meet or be no higher than the affordable threshold. And so you're in Edmonton at 1,665 nominally, but you're in the neighborhood where the market rents are 14 and a quarter. So now you've signed up for 14.25 for 10 years. Now, and the way that's determined is from Statistics Canada data that shows what the Edmonton median income is. So let's say next year the inflation's running high. Let's say that inflation continues on a roll, and we've got 2 or 3 years of this 4, 5, 6, 7, 8, 9% inflation a year. And StatsCan, if we've got 8% inflation, they're reporting probably 4 because of the way it's built. And I don't think that's going to change because there's lots of reasons they don't want that happening. So even at 4%, let's say wages in Alberta go up by 6, and the new median rent instead of 14.25, the nominal median rent would be instead of 16.65, maybe it should be 17.40, and maybe your market rent in that community where your building has gone from 14.25 to 14.90. You're not going to get 14.90.
Oops. You're
going to get the rent you started with, unit by unit, plus the either inflation, so 3 or 4% or 2%, whatever that is, tacked onto your 14.25, or rent control, whichever is applicable in your province.
Mm-hmm.
So you are signing a 10-year commitment to very limited increases in your rents. And if you can handle that, if that's financially viable for you, good on you. It works. Yeah. But that is the reality.
That's
and
the
now
reality.
We've asked several different ways. So let's say, after a couple, 3, 4 years over time, the 10 units that you've assigned to be affordable isn't not necessarily the ones that you want to have affordable anymore. People move in, people move out, and you decide that, you want to do a couple of renovations. So you've got affordable rent in unit 101 and 304. And those two people move out 2-3 years down the road. And though they were there for 15 years and the units it's perfect time to renovate and improve them. Will CMHC allow you to appoint different units to be the affordable ones as long as you meet the numbers criteria? They're saying that's not in the plan, but they're getting a lot of pushback because that would be proper and appropriate, and wouldn't put anybody out, and would allow landlords to improve their buildings over time, which is really critically important.
Yes. But folks, as you listen to Garth talk about this, he is doing a wonderful job of explaining what is an extremely technical exercise, working with CMHC and getting approval under the Flex program or the Select program. It's a technical exercise. There are hoops after hoops after hoops to jump through, and so this is more of the same as we start to talk about the MLI Select. And that the affordability thing. All right, so that's affordability. Let's move on to another thing we've discovered in this last week as you peel the onion.
So a couple of things. So the all three of these initially were announced that the commitments that you made had to be achieved at the time of funding. So there was some pushback on existing buildings. How are you going to achieve affordability when you don't control the building and you don't control the rents and there's leases already in place? And the answer is, you got what you got. Deal with it. On the side of energy efficiency and accessibility, what they've agreed to do at this point is to say you must sign an attestation within 60 days of closing and funding the mortgage that you've achieved the commitments that you made in those two areas. That's great, but I can't imagine how in an apartment building you make any accessibility changes, improvements, or frankly, any energy efficiency improvements sufficient to make the criteria. On the energy efficiency side, you got to be 25% better than the building used to be, or 25% better than code, depending on various things. I don't know how you do that in 60 days and get it achieved and be able to show that it's working. And now you don't have to show by showing receipts for the bills you've paid on energy costs. They will name this month a great wad of engineering people across the country who are accredited to do the analysis that proves that if you do this and this and this, you're going to reduce your costs by that and your GHGs by that, and that you qualify, sign, here you go. It'll cost you to get that, but all you have to do is do those things. So I think that'll be tough on existing buildings. The other thing I wanted to touch on, and I missed earlier on, is fees and premiums with this new program. So if you took an MLI Flex deal last year, this year, up until March 7th, and you went to the maximum 40 years and the maximum 85% loan to value, you'd be paying CMHC fees of around 5%. 5% of the mortgage amount. That's a big number. Yeah. Under MLI Select, it'll be as low as 1%. I think it's going to end up being no more than about a third of what the previous premiums were. So if you were paying a premium of $80,000 on XYZ building, I think under the new program, it's going to be more like 30-ish. That's a big savings.
That's big.
That's cash.
That's big.
Now they can, that's added to the mortgage, much like CMHC fee premiums on your own home, but it's still a big number. And the debt servicing on that is significant, and it's, again, makes it more affordable. So that was a good thing. Energy, accessibility, fees and premiums. There was something that hit my brain a minute ago.
Well, your brain will spit that out. Let's pop up a question or two while your brain is processing in the background. Kim says, will this decrease the value of 4-unit and less multi-use buildings? Will this program decrease the value? Not sure what Kim means. Probably will the program. Yeah,
I think it's exactly what she's saying. That's a great question. I've not thought about that. My initial reaction would be to say no, because they're not playing in the same playground. And those, frankly, 4-unit buildings now are at a real premium, certainly in Alberta. and they're tough to find, as is everything else these days because inventory is so low. I don't think it will. My initial thought would be no.
All right. If amortization is 50 years, is the rate fixed for 50 years?
No, there are 10-year rates and 5-year rates available, but nothing beyond 10. 10 is great, by the way, because they've been so low. I will say this, though, brings up another point in my mind, and that is that there's a gap between market value for multifamily properties and lending value.
Right.
And the down payment is based on lending value. So let me try to give a real layman's explanation of this. There's a building for sale, and it's, I'm going to say one more quick thing too while I do this as I think about that number. If you're asking for a mortgage below $3 million, you're small fry. The bigger lenders, well, they'll do the deal maybe, but they're not going to do you any favors, and you're not going to get any exceptions. If it's at around $2 million, you might get a little bit of help there. But there are smaller lenders out there, and that's where they feed. That's their bailiwick, and they'll do everything for you. But the big guys, not so much. Beyond 3 million, it's nice. Beyond 5 million is where they all want to be. I know of at least 2 big lenders who in the last year have been their sales side have been told by the chiefs to reduce the number of deals they're doing under 3 million, because they're almost as much work as a deal for 5 or 8 or 10 or 12 million for much less return.
Yeah.
And one of the ways they dealt with that is the rate spreads that they were charging on those smaller deals, and still are, were much higher than they were on the bigger deals.
Yeah. That's important to know.
Or on refinances. Or renewals, I should say. Renewals were getting better treatment. There's no work, not much work involved in a renewal.
No.
But lots of work in a new mortgage. So let's go back to lending value versus market value. And Barry, I know you're aware of this, but many people are not. And it can be difficult for people to understand because it's just such a foreign idea. Let's say we have a building that's listed for, I want to use easy numbers. So it's $1 million. And by God, it's worth $1 million. When you look at the rent rolls and you do your analysis of the net operating income, or NOI, it looks good, and it'll carry a mortgage you think of, $800,000. So that'd be 20% down, not quite 15, looks pretty good. We get to a lender or to CMHC, and they look at all the numbers and go, yeah, but we're going to decline your 5 cap, and we're going to say, your 6 cap rate, and we think it's worth a 5 cap. Now your value just went down. They're going to look at the rents and say, some of these rents are actually above market, and we don't think they're sustainable. We're knocking that back. You've not allowed enough for vacancy. We know what vacancies are: 6.2 in Calgary, 7.2 in Edmonton at last measure, which was December, I think. And 6.6 in Calgary, which brings up another problem. Remind me to circle back to that.
Okay.
So by the time the lenders got through the analysis, and then CMHC gets at it, and they're very fussy with this stuff, they've knocked that lending value of the building down from $1 million to $850. And now they'll look at, what does the net operating income support in terms of a maximum mortgage? Is it 85% of $850? Well, turns out it's not. It's 79.25%. It's a number, which turns out to be a percentage, but they're going to give you $650. So now you're getting $650 on a building they say is worth $850 that you got to pay $1 million for. So your down payment is really what? 35%. Nominally, as far as the lender and CMHC is concerned, it's more like 20%. And realistically, when you look at it, and this has been true for many, many years, if you're trying to buy a building in a major center in Alberta, you're typically looking at 85% of lending value is typically around 30% of market value. So your real down payment isn't 15%, it's more like 30.
So that's a big shocker for people to realize how the difference between the market value and the lending value. I mean, that's big. That's huge. Wow.
It's also an opportunity. And the smart people who have enough capital will then buy the building, as I described earlier, will buy the building with a conventional mortgage. They will stabilize the property by increasing rents, doing renovations, improving, environmental impacts, maybe accessibility, etc. And when they've got all that done, they've probably got a 2-year term, and well into the first year they've got it running, and they've got a full set of financials to show. At the end of the 2-year term, they then will refinance it with a CMHC insured mortgage and pull their money back out. So they've spent a year or two with a lot of capital tied up, but at the end of the day, they've made the building worth more money by improving the net operating income. And the payback for that is they've got a bigger mortgage and less capital tied up, and they therefore can go back and do that again. And there are lots of big players out there. Who are the guys out of Vancouver, Barry, that do this in Dallas and Phoenix and in Florida and various areas?
Dave Steele and his group. Yeah.
And they're brilliant at that. They buy underperforming assets, and they have a fantastic model for improving them. They raise capital from investors, accredited investors, $100,000 minimum, I think, and they make lots of money for people, I think. So that can be done on a small scale too. The risk in doing it, though, is if you get into a market downturn, it'll kill you, it'll cripple you. And I've seen that happen to many good people. After 2008-9, those that were in the early 2000s got hammered. Some lost lots. And then we had a little run up again in 2012, 13, 14. People were at it again. Then we had 15, 16, 17, 18, 19, and a bunch of people got hit pretty hard there too. So you got to have a stomach for this, or you do it in a marketplace where it's not so cyclical.
Yeah.
And Alberta is cyclical.
Lots of cycles and lots of questions. Let's pop up. If amortization is 50 years, is the rate fixed for 50 years? I think we already did that one. We did that one. You get a 5 and a 10-year term, but not fixed for 50. What are the fees to break a 50-year amortized mortgage? Oh my God, Garth.
Well, you're breaking the term, in a sense, but CMHC insured mortgages are basically not breakable, period. You can try to sell the building to a new buyer who is qualified, and they will assume the mortgage if they qualify to CMHC satisfaction and the lenders. But you're still on the hook for your covenant, your personal guarantee, until that term expires. It is very rare that happens.
So folks, don't go into any of these CMHC programs thinking if you don't like it, you're just going to exit. And what else we got here? A couple of quick questions regarding construction costs included in CMHC's calculation under the Select program. Number 1, is sales assessment tax considered part of the total construction cost?
I think that must mean title transfer, probably, to the land. Yeah. That is part of your cost.
Is there a fund under the program that will allow paying sales tax associated with construction cost expenses, or there needs to be a reserve that is raised?
I'm sorry. They're referring to GST and HST, I think.
Yeah, that makes more sense.
Yeah, I believe they are. I believe they are. But, typically you're not a builder, so you're not incurring those. You're incurring those if you are a builder or a developer.
Okay. Holly says she used her line of credit to buy a sixplex. Will CMHC allow me to pay myself back as I am refinancing right now, or does the money have to go to build the portfolio?
Generally, there are some exceptions now being granted around that. Many of the lenders won't go ask for that exception because you're too small. Some will. We probably could, through our direct submission, get that to be allowed. You have to have a really good trail of the money to prove it. But that looks to be achievable now. And I've spoken directly with a pretty senior CMHC person actually out of Vancouver who's been very helpful to us over the last couple of years. And that's where we learned that originally, and I've confirmed it with a couple other sources.
Okay, thanks, Garth. Can you condominiumize some units and keep others back as rentals? Well,
there are instances where larger buildings are, some entire floors are rentals and other entire floors are condominiumized and sold as individual units. CMHC does have some appetite for that under some pretty stringent controls. Pretty tough for a small investor to pull that off, but it can be done. And frankly, there are also buildings where, CMHC will insure a mortgage on a multifamily building if up to, I want to say 20% of the rentable square footage is commercial. So on the main floor, you've got storefronts, and as long as it doesn't cross over that threshold, that percentage that's allowable, it might be 15 or 20, then the whole thing can be insured. If it does, and there are instances of this over the years has happened where, there'll be a separate mortgage for that ground floor for those non-insurable portion, and you have two mortgages on the building, and away you go.
Yeah, it can do split mortgaging for sure.
Yeah.
All right. I think maybe we've run through the questions. That's it, says Wayne. Super.
There was one more.
Interesting.
One thing I'd like to add, Barry, if I could, just for a quick moment. We have it under pretty informed. We have pretty informed opinions that this will not do overly well in Alberta and probably Saskatchewan until our vacancies come down. And the rationale being CMHC is not going to want to put a lot of effort into insuring mortgages under this program in areas where vacancy is not low, because they're not solving their number one problem, and that is affordability and accessibility. If vacancy is not low, as far as CMHC is concerned, there's not a problem. In Edmonton, over the last year, CMHC has been quite concerned about Edmonton because developers are not filling up the new buildings, and they're having to ask for extensions on closing and funding. And it's not just one or two, it's a good number of them. And it's not only just the bigger buildings downtown and near the downtown core, but it's others as well. They drove up the cap rate in Edmonton as a result.
Yes, that's that's important to know, because the CMHC is as you say, a federal crown corporation. Its remit is Canada, but its application is local in lots of different things. You were talking about how on the affordable rent side, they will drill right down into a community to figure out what the rents are, in a community, and maybe in larger ones, they'll divide it up into chunks of a particular community. So
absolutely.
It's important to know. That's really, really important to know. My goodness.
So I think the opportunity in Alberta is going to be, as the economy opens up and people move here, the immigration is ticking up again. The immigration from outside the country is ticking up. Oil and gas is strong, and I think that's going to last for a while because we've not reinvested anywhere in the world in oil and gas development. So there is and most of the Middle East countries are pretty much tapped out with the volumes that they're producing. They don't have a lot of room to produce more. So I think we're going to see a pretty good run. I would suspect in 2-3 years, probably 3-ish, we will see a big cratering in vacancies, and we will see more housing being built. And well, we are seeing it now being built, but we're going to use up the inventory, and we're going to see the vacancy drop. We're going to see rents go up, and we're going to see wages go up. And we're going to start repurposing some of the downtown core in Calgary. Yeah. Edmonton's done a fabulous job of improving its downtown core. I think 2, 3, 4 years, this will be a really good program. And it's a good time for investors to be thinking about, how do I prepare myself? Because 2 or 3 years goes by pretty quickly. And it takes some time to prepare yourself if you want to make that step up and that move up. And something that we do that I think is a little unusual is that we've built a complete process around pre-qualifying, if I can use that term, people in terms of their ability to get into multifamily. Are they going to meet all of the criteria that's required? So before, if you're not already an investor in the multifamily sector and you want to know if you can be, we'll do the workup to figure out if you've got what it takes. And if you don't, what you've got to do to change that, that when you come to us for a building, we know that you're okay. And now it just comes down to the building.
All right, Garth, let's look at this last question. Looks like we've got some more explanation from the previous question. Questions regarding the sales assessment tax, sales tax. MLI Select has 2 branches, if I'm not mistaken, one for existing and one for new construction. My questions were about new construction.
Yeah, and I honestly don't know the answer to that. If Barry, you can get me his 2 questions, I will find out and send it back to you.
All right, Donna will be all over that. Garth, so we've come to the end of tonight's program, but folks, I want you to realize that you have a huge resource here in Garth and his company GenCore. GenCore has been around for a long time. They're full of very smart people who really know what they're doing. They're hugely well connected across the country. And so if you want a company full of people who have your interests at heart and really know what they're doing, I mean, Garth's your guy, and GenCore is your company on lots of different levels. And no hesitation about saying that, because I've been dealing with and talking and working with them for a long time. So I'm going to leave it at that. I'm presuming Donna has put up your contact details, Garth, or she will be doing that so people can get hold. She has done that. I've been watching you. I haven't been watching what Donna's been doing, but she has been. So folks, get in touch with Garth. Join us next week. And join us next week, because we're going to come back and do this again. We're going to go back to square one and talk about buying a multi and what does that mean and how does CMHC work into that basic scenario.
Right.
So Garth, I mean, an hour went by zip. I mean, it just zips by. It's, we're scratching the surface here. So I really appreciate you taking time away from being in what's, I mean, sounds wonderful. 27 above, you're going to have a glass of Prosecco on the deck and look at the sunset, I'm sure. Something like that.
Indeed.
So thanks again.
Sorry. Thank you again, Barry and Donna. As always, you're just so much fun to be around. I miss, not being able to come up there and have a beer in your backyard, your unbelievably beautiful backyard. So we'll do that once this kind of clears up, and we'll look forward to maybe being able to do that this summer at some point.
Me too. We would love to do that. So
in May,
and maybe we'll see you in Calgary in May at the Rapid Cash program if you
absolutely
work your way back.
I'd love to come. I'd love to come over there.
We'll get you finance boffins duking it out. This will be great.
Cool.
All right, everybody.
Good.
That's it for tonight. Thanks for showing up, and come by next week, and we're going to do this with Garth again. I'm really looking forward to that. So thanks again, and good night, everybody.